I've always thought, people ask me, what would make good real estate? And of course, the answer people always give is location, location, location. And I guess I would say that is not exactly how I think about things, because I think that real estate follows societal trends. So, real estate is the place where people experience life. That's how I define real estate. And so good real estate is the physical place where people will want to experience life for the foreseeable future.
REZA Insights provides timely content from the real estate industry's preeminent thought leaders, with insightful and thought-provoking subject matter, covering the relevant topics of the day to help inform our clients and the broader real estate community. REZA Insights is brought to you by REZA Investment Group, Inc., and is moderated by Reza Atadali, CEO and founder of REZA Investment Group. This episode will discuss the overall state of the U.S. capital markets and real estate markets, and a forward-looking capital markets outlook. Featuring keynote speaker Ethan Penner, a distinguished subject matter expert in real estate finance, who has widely been recognized as the creator and father of CMBS. Additional panel participants that will contribute to the discussion include Sandy Sigal, President and CEO of Newmark Merrill Companies, Stuart Tanz, Chief Executive Officer of ROIC, and Simon Ziff, President of Ackman Ziff Real Estate Group.
Hello, everyone. This is Ramez Barsoom with REZA Investment Group. Our team would like to wish each of you and your families a very happy and healthy holiday season. Thank you for joining us for our Capital Markets Insights webinar, discussing the overall state of the U.S. capital markets and real estate markets and a forward-looking capital markets outlook for 2024. For today's live session, we've kept the audience to a limited number of our clients at the senior level, and today's topics of discussion have been crafted in response to the collective questions and feedback provided by today's panelists and the broad client audience. Today's webinar is being recorded and will be available to a broader group at a later date. As a reminder, all participants' lines are muted. We have collected questions from the audience prior to today's event and have integrated those topics into our discussion today. We're pleased to be joined by our keynote speaker, Ethan Penner, founder and managing member of Mosaic Real Estate Investors. Ethan is a recognized pioneer in the fields of real estate and finance, specializing in real estate, mortgage credit, and financial markets. And he's most well known for his work with Nomura Securities in the 1990s, where he's broadly credited with being the driving force behind the creation of the CMBS industry. In addition, we're pleased to be joined by the following industry leaders as guest panelists today. We have Sandy Sigal, Chief Executive Officer of Newmark Merrill Companies, Stuart Tanz, Chief Executive Officer of ROIC, and Simon Ziff, President of Ackman Ziff Real Estate Group. The panelists' bios have been emailed to you directly in a previous email. In addition, at a later date, we'll provide a link to the recording of today's discussion, along with a link to Ethan's recently released book, Greatness is a Choice, published by Wiley. Our team would like to thank each of our guest panelists for participating in today's event. And with that, I'll turn it over to our CEO, Reza Atadali, to begin today's discussion. Thank you again, and we hope that you find today's webinar both informative and beneficial. Reza?
Thanks, Ramez, and hello, everyone. Happy holidays, and wishing you and your family a great new year ahead. We are dealing in a world where there's a lot of volatility, obviously, in macro and in the economic and political landscape. And there's a lot of volatility in interest rates. A lot of you looking at 2024, wondering where things are headed and how to position yourself against potentially a storm coming and the market volatility. Who would be better to have here than Ethan Penner to talk to us a little bit about his historical perspective of where the capital markets has been, his experience there, as well as where he thinks we're headed. Ethan also has recently written a book called Greatness is a Choice. I've started reading it. It's a great read. I highly recommend you take a look at it and read it. With that, Ethan, thank you so much. Ethan's going to start giving us a talk for the first 15, 20 minutes of the session. And our panelists are going to moderate this with me and asking questions. So Ethan, thanks so much for joining us, and we'd love to hear your perspective as how you see the world and where you see it going.
Thank you very much, Reza. Thanks for including me, and for the nice plug in my book, which I am also very proud of. And I wouldn't say I'll give everyone a money back guarantee, because I don't know how many money back guarantees I have to have out there, but I do promise everyone who will enjoy it, I think. So I'll speak for a little while about, you asked me to speak a little bit about my background, Reza, correct?
Yes.
Maybe as it relates to that. I'll start with that, and then I'll share some thoughts about now. Uh, as I've said, Simon Ziff, who's like a brother, he has an open invitation to interrupt me. So, and anybody else can do that too. But I started out it sort of started out where I started my career. I'm a credit guy. And that's really how I've evolved my career: a real estate credit, a mortgage credit guy. And in the kind of biggest dislocation, bigger than 2008, really bigger than any time that of modern times, the early 1990s for real estate, there was no lenders, and I think that when people think about, one of the things that I think is valuable is perspective. So when I started out my career and I got out of college and I was looking for a job, and I think that probably some of you are a similar age to me, the 10-year treasury was over 15%. And when we think about that, and we think about how, Jerome Powell has used interest rates to squash economic vibrancy in the last 2 years by raising interest rates, and the 10-year kind of hit around 5 and now is in the low 4s, and how concerning that has been to us. It's almost laughable when you juxtapose that against the 15% 10-year that I came out of college into. And similarly, today is a tough time to get a loan, right? I think that lenders are definitely sitting on, I don't know, a lot. They're sitting on a lot of challenges. I'll just be diplomatic and say challenges today, based on what's in their portfolio from having originated in the last, the prior 3-4 years, when cap rates were different and the environment was different. And so the reaction is tightened credit. Well, and today we're living in a tightened credit environment, but it still pales in comparison to the tightened credit environment that I kind of walked into and saw in the early 1990s, when you literally couldn't get a loan. Like, it didn't matter who you were, it didn't matter what your asset was, and it didn't matter what your LTV attachment point was. Your lender, when your loan came due, wanted out, and there was no other lender who wanted it at any level. And it was that incredible dislocation that allowed someone like me in my very early 30s, I was 30 or 31 at the time, to kind of leave Morgan Stanley, where I had built and run mortgage finance, structured mortgage trading, and utilize the same kind of relationships that I had built on the rating agent side, on the bond buyer side, and structured finance technique to create CMBS. And, it was in a moment of desperation. It wasn't that CMBS had not been tried before. It had been in the late 80s. It's just that there was such an abundance of traditional lender capital in the late 80s that there was no reason why a borrower would acquiesce to bond-like documentation and the strictures associated with that. And so CMBS couldn't take off in the face of competition. But when there was no competition, and when every lender was desperate and would take any loan as long as they could refinance their existing credit and stay in the game, then nothing mattered except just getting that loan closed. Terms didn't matter, rate didn't matter, nothing mattered. And that created this opportunity. So the reason I think it's relevant to talk about that time and maybe bring that to bear today is, not only is our industry, real estate or real estate finance, depending upon what angle you're playing it, kind of in a really interesting period where there seems to be a unique opportunity for new ideas to come around, and for game-changing ideas. But I think it's a time in the world where all systems are tired. Most systems whether it be banking system, healthcare system, political system, most systems that kind of matter to us and to people were built for a completely different era that doesn't resemble today. And I think that that's very exciting for people who are change agents, who want to be change agents. And I would say everyone should want to be a change agent because nothing's more fun than that. And so this is, while this is a very difficult time, I think things are breaking all around us. And I think that those of us who can think of tomorrow's model for whatever it is they choose to invest their time are going to be extremely well rewarded for that. I think that real estate follows society, right? So when you think about what makes good real estate, I've always thought, people ask me, what makes good real estate? And of course, the answer people always give is location, location, location. And I guess I would say that that is not exactly how I think about things, because I think that real estate follows societal trends. So, real estate is the place where people experience life. That's how I define real estate. And so, good real estate is the physical place where people will want to experience life for the foreseeable future. Experience it, whether it's retail experience or entertainment experience or residential experience or work experience or whatever experience it may be, it's experienced inside of real estate. And I think a good real estate investor, which includes a lender because you're investing, is someone who understands where society is heading tomorrow and invests accordingly. Where does society want to experience life tomorrow? What are the physical structures look like that within which people want to experience life? What is the location that people want to experience life, et cetera, et cetera? So to be a good real estate person, I think you have to be a good sociologist. I think you have to understand broader political trends. Look, it would have been saving people who invested in San Francisco in the last decade. It would have saved them a lot of money if they had thought about the politics of San Francisco, which ultimately has undermined the vibrancy of what might be the greatest city in America, if not the world. And now is a place people don't want to go. It's shocking what's happened there. So I think that I wrote a book on philosophy, and that's what you referenced. But philosophy touches business, touches real estate, and I think to understand any of it, you have to understand all of it. And I try in my book to bring the tie-ins to that, but I think that's important to mention here. And I think that to understand capital flows, to understand societal desires, then leads to understanding real estate valuation and how to invest in real estate. And I think without that link, you're missing most of everything that matters. So, when I got this wonderful opportunity backed by Nomura in the early 90s to address this historical void and bring something creative, a creative new solution to the real estate industry, I was a 31-year-old guy, who had no real estate experience whatsoever and had to learn about real estate from the finance side. But it tells you how opportune massive dislocations are, that a 31-year-old kid can get to the head of the line really quickly. Perhaps one of the other things that is instructive to remember from that moment, which is, I think, relevant today, is finding financial partner in a time of extreme dislocation is probably the key to really being able to be successful. Because had I not found Nomura to be my partner, I'm not so sure. I was already a little successful. I had convinced Cargill's financial department or investments department to back me before I had run into Nomura. But it was really the Nomura backing that created the platform for me to make a very, very big difference and create really an industry. I think everyone on this call today understands how hard it is to persuade investors to back them for whatever it is their ideas are. And I think nothing is more important today than having a differentiating viewpoint and then being empowered to pursue that with capital. I think the investing side of things, well, it's not exactly all low-hanging fruit. I think that there's a lot of uncertainty still in the market, maybe more than ever. And that's another thing I'll talk to you briefly, and that is kind of the amount of variability in how things might play out is as high as perhaps it's ever been still. So, when you think about the wars and the social protests that we see in our streets and in our universities, the crime situation in many of our cities, crime that doesn't even go prosecuted, or where DAs let people out pretty easily, the blue-red divide in our country, the immigration issue. I mean, I think there's a lot going on. The deficit and the debt and servicing the debt and the politics of everything. It's a mess out there. There's no question. And
Ethan,
yeah.
Is this where I get to interrupt you?
Why not? Why not?
Okay. That time when you created the CMBS market, we all saw it was a game changer. And I think the change was going from bank recourse financing to non-recourse financing, as well as the massive liquidity that you brought to the market. But before the panel gets into the panel discussion, you're talking very high level, which you always do, and I always have to spend time after our calls figuring out what the hell you said. What is the change that you think could happen over the next year or two or three out of this? Because I don't think we're in the same type of crisis that we were in 89, 90, 91 in terms of liquidity. Do you see something changing?
Well, I think the biggest difference between today and what anything post 2009 and anything pre 2009 is that the Fed has showed its hand. So in 2009, the Fed showed its hand for the first time ever, which is it basically said, we're going to print as much money and pour it into the system as we need to avoid anarchic dislocation. And that's really what happened in 2009. And now you have a post 2009 world where everyone's alive remembers that. And so every time there's a threat of kind of anarchic dislocation, everyone just looks at the Fed and say, okay, Fed, do your job. It's like, now it's your job, right? It's your responsibility. And if they don't do it, well, I mean, what is their excuse for allowing anarchic dislocation risk to perpetuate when they stepped in 09 and since numerous times to avoid that? So I think we know the playbook. Whereas before 2009, including 1991, there was no playbook like this. It never happened before. So I think that's the biggest difference. The biggest difference is we have a market that has been hijacked by central banks in order to affect political and social change or to stem political and social unrest. And I think we'll see that play recur as whenever it needs to recur. So that's the biggest difference, Simon. And I think that with all of that kind of risk out there and all the things that I said before, I do think that the trend will be towards lower rates for that reason. I think that we're moving into an election year where it does look like Trump is way ahead in the polls and highly likely to win, it seems, by the polls. There's a kind of like an organized system that I think would go to any length possible to avoid that outcome. And I think lowering rates will make a more compelling Biden or Democratic candidacy, and I would expect that to occur. Plus, I think that with rates anywhere near 4, we have incredible deficits and an incredibly large debt to finance. So if you were the borrower and you also could control the rate that you paid, wouldn't you manage it lower? I mean, it's pretty simple to me. And that's the case we have. The US government is the biggest kind of debtor in the history of the world. and it can control the rate it pays on its debt. So why wouldn't it manage that debt rate lower, you know? So I think we're going to see lower rates. I actually thought, I was quite surprised that the fact that the largest debtor in the world allowed rates to be moved higher as they did.
A couple of questions relating to what you said. Are you at all worried about the massive deficits that U.S. has and the concern that who's going to buy the debt? That's one. And secondly, with number of big value investors are saying that, the era of low inflation is potentially over because the global macro world and the fact that the world is decoupling in terms of globalization. We're going to deglobalization. What are your thoughts on that, on these 2 points?
Well, I think that they're both interesting. First of all, let me start with inflation. Because I think inflation is misreported and misunderstood. And if your listeners were to go to the internet and type in, instead of CPI, alternative measures of inflation, and they're very easy to find, then for the period of time kind of post 2008, there was a decade or more that CPI ran below 2 and closer to 1. But alternative measures of inflation showed a much higher rate, between 6 and 10% during that same period of time. So I think that inflation is misreported. Part of it is because there's different inflation experiences for different socioeconomic strata. So if you're at the very bottom end of the socioeconomic strata and you're living in subsidized housing and you're eating fast food at McDonald's, then I think you experienced very little inflation in that decade that I referenced. But if you're in the strata that everyone that's on this call is on, well, everything went up by something between 5 and 10% or more each year, whether it be tuition for private school, vacation travel, home purchase price, everything, right? Food, everything, restaurants, everything you consumed has been going up by 5 to 10% per year since 2008 or 9. So I think inflation's very tricky to put your handle on. I do think that this globalization, it had gone very far. There was under Obama was a big proponent of globalization. It was one of the keynotes of his presidency. I think he seemed to, he was big into that. I won't make any editorial commentary beyond that. And Trump came in and he was big against that. And he was for an America agenda, which was about bringing jobs back here. And I think that you're right. I think that there is and that will create tension, right? That's part of this. We're living in a tension period, I think, in the United States, right? Where, yes, jobs are coming back to the United States because of the deglobalization. But then you've got there's been a lot of union issues that have percolated as a result of that. And the squabbles between unions and employers. And I think that's going to continue to be something we see in our country. I think that the interesting relation between that point, which is the deglobalization, and the resulting union fights between worker and owner, is very well tied to the other point you mentioned, believe it or not, which is debts and deficits. In the end, I think it's all about redistribution. In the end, we are going to live through, I think, in the next decade or two, a significant redistribution of resources and wealth and opportunity in this country. And it's going to be, hopefully civil. It will not always be civil. I think that there's going to be a lot of tension in our society to undo the polarization between the haves and the have-nots that have happened over the last 20 or 30 years. And I think that'll be a big part of the American experience going forward.
So Ethan, as we look at this coming year, a lot of the investors who are on the call have potential refinances coming due. They're positioned to buy assets, positioned to take advantage of opportunities. Can you share with them your insights as far as what do you see the capital markets going? Do we potentially see a GFC situation? Give them some insights.
I think that we don't see any kind of like GFC moment, I don't think, where we hold our breath and hope the world doesn't end. I don't think we're going to see that because GFC happened and there's now kind of a central bank plan to deal with that as it gets close to that. So I think bells will go off in Washington before we get to that. I hope. I do think that rates are heading lower. Most people agree. I think that that will be extremely valuable to real estate that has cash flow, that I'll call as viable real estate. So if you own viable real estate and real estate that's occupied with cash flow, what I would tell you, if you have refi coming up, just be a very good borrower. I was a very big lender. Lenders don't, for the most part, get in this game to own real estate. There are very few. There are some who are, so-called predatorial, but the 95 or 98% of the lenders, they really make very good financial partners. And maybe you need to pay them a little for some extension or for some patience, but they want you to win as long as you're a decent borrower, as long as you do your job well. And the last thing they want to do is try to do your job better than you, especially if you do your job well. So I think that what's one of the nice attributes of being a real estate borrower is that there's a disinclination towards kind of upsetting the apple cart by the lender and going through foreclosures. That's the last thing that most lenders want to do. So be a good borrower, be very transparent, be very communicative, very proactive in communicating with, and I would recommend face-to-face meetings as much as possible. So those are the things that go a long way towards engendering trust. Trust will lead to you getting extensions that you might need, or whatever things you might need in order to survive a bumpy road. Maybe a year from now, the world's going to be a lot less bumpy, especially rates might be significantly lower and your deals pencil out better than they do today. So do what you can to cultivate goodwill with a lender. That's my recommendation to every borrower.
Ethan, let me ask you a question. We're going into a very interesting year, I think. We obviously have an election year. I think there's a rise in populism, right? There's a disconnect. Rent rates are very, very, very high. As you said, there's been a lot of union stuff going on. And places like China, as an example, a big investor, loose investor in our T-bills is there's definitely a trade war at least going on. What for us would be the tells between now and election day of what we should be concerned about, what we should keep our eyes on? What are the critical things that you're going to be looking for?
Well, first of all, I would not worry about China on a financial level. They own $2 trillion of treasuries, if I'm not mistaken. It sounds like a lot. It really does. But there's 33 trillion outstanding or something like that. It's not a big deal. It's just not. If the Fed wanted to, that could be absorbed into Fed system, including commercial banking, in a day. So I wouldn't worry about that at all. There are things to worry about. And I think that's really an important question that you kind of were asking is, what are the important things to actually focus on? And what are the things that perhaps are just a lot of noise in the background? The China Treasury ownership is noise. It means nothing. I think there's a couple of things about that are interesting to me. One is how much higher replacement cost has gotten for real estate. I think too little attention is paid to that. When people go, the world is falling apart, real estate is on the verge of collapse. And the reality is, historically, when replacement cost is so much higher than the kind of valuations at which people are in and exposed to real estate, generally that's not true, So I mean, replacement cost is an interesting thing to continue to look at. It has its own nuances, but when it's significantly higher than basis, that tends to be a good thing for real estate stability. There's also a historic amount of money in money market funds. There's 7 trillion, I think, in money market funds. 7 trillion in money market funds. Okay, it's crazy, and it's because money market funds started paying 3, 4, 5%, and so as that money is basically seeking safety and figured, I'm not, in that trade-off that Warren Buffett talks about, safety versus greed. There's a huge vote for safety. That's what that 7 trillion in money markets tell you. And the question is, when does that start to flip towards greed? And it's a combination of when the rate paid on money markets starts to decline, and when it feels like there might be some opportunities that are significant that are being missed in the investment world. So, I think that real estate, the stock market is, people in real estate have to always remember that we're all competing for the same money with every other investment alternative, right? Whether it be money market funds or stocks or bonds or, overseas investments. And so the question that I always used to ask myself, because I grew up on a bond trading desk, is on a relative value basis, how do I think about today's investment opportunity in real estate, let's say, or in real estate financial products, whether it be REIT stocks or mortgages or CMBS or whatever? How do I think about the relative value of these versus other alternative investment options that I might have? And I think that can give you an idea whether the wind's at your sails or the wind's right at your bow, and I think that's how I look at things. And I think today, the stock market seems to be pretty fully priced. I mean, I don't feel like if I didn't buy stocks today, I'm going to miss out on some historic bull run. Although I have to say, oddly enough, I think that the likelihood, if you ask me to put a gun in my head and say, do you think stocks at the end of next year are going to be higher or lower? I think they'll be higher for the reason that there's $7 trillion in money markets, and a lot of that will find its way into stocks. I think bonds will be higher, meaning rates will be lower. But I also think that real estate really involves more salesmanship than these other things, right? I'm sure everyone listening to this, including you and maybe Sandy and Stuart, Simon, everyone in real estate who's good, and everyone who's, by the way, as old as everyone in this call is good because you couldn't still be in the business if you weren't somewhat good. And part of being good in real estate is you're a good storyteller. You're a good salesman. You're a good communicator of relative value. And I think that skill today is going to be the skill that's going to be differentiated. Because I remember, again, when I go back to my Nomura story, it wasn't that it was easy to make money, right? I mean, there was no competition. All I needed was capital, and I needed to persuade capital to back me. And once I persuaded capital to back me, the hardest part of the job had been accomplished. I think that's not terribly dissimilar from the world we're in and going into right now, which is those who have capital are likely to succeed because I think this next vintage is likely to be pretty good, for the simple reason that there's not a lot of capital kind of chasing real estate today. So if you're one of the lucky ones that have capital and you're reasonably discriminating or discerning, I think that it should be a pretty good time.
So Ethan, I'd like to ask you, when you talk about looking out of the next year to 2 years, because I think the basis of this presentation today is really to look forward versus looking back.
Right.
The pipeline out there in terms of our business is quite sizable, but it's just not actionable at the present moment. And certainly, buyers and sellers are not yet comfortable sort of finding what I would call or determining values in today's market. And we all know a lot of this being, a lot of this is having this friction because of, as you've talked about, the Fed and what's happened with interest rates over the last year to year and a half. Most investors, or we'll call it, institutions out there, aren't going to really get actionable in the market until there's some clarity on valuation. So if I look out over the next year or maybe 2 years, and I know in election years, historically, if you go back and look at election years, there's a slowdown in terms of transactions. So in your opinion, or maybe if I can ask, if I look out the next year to 2 years, and although none of us can call the tops or bottoms of the market, and certainly our cost of capital has got a bit better since the Fed gave us a nice Christmas present a week and a half ago. Or if you look out a year and a half, when is the right time to start thinking about deploying capital? And should we be looking at deploying capital in different alternatives, as you're saying, in the real estate world?
Well, I think that I disagree. I don't worry about things slowing down. You said it's typical in an election year that volume slows down.
Yep.
I think that it can't slow down too much from where it's been for the last 2 years. We got our slowdown in 2 years ago, and I think when rates started being marched up, and I don't think it can slow down from here. Actually, Stuart, I think that different things are going to be attractive at different times, and has to do with viability risk. So there's two kinds of real estate. There's real estate that is there's no viability risk. I don't know if I pick one as an example, maybe it's an apartment in a very densely occupied apartment neighborhood, right? That to me has no viability risk. On the other side, of the spectrum, maybe you take an office building in downtown LA that has the highest level of viability risk. And then there's stuff obviously in between those two, because that's the ends of the spectrum. So I think that speculative versus investment grade is kind of how you have to think about real estate today. My sense is that investment grade, which is the very low viability risk kind of basket of real estate investing, is actionable as soon as you can get a decent return. As soon as you have a good manager who you can trust will harvest the full value of that investment. And if you could get in, which in many cases today, you could get in at reasonably significant discounts to replacement cost, and even discounts in recently constructed buildings to actual completion cost. If you're in viable real estate and you're in that spot on the kind of relationship to actual completion costs and replacement cost, and your cash flow yield is sufficient, I think starting now, like in apartments, by the way, I already see pretty good opportunities. And I think that you don't have to wait for, in 1991, I'll never forget Barry Sternlicht. When I first met him, he and Bob Faith had their first fund at Starwood, and they had $65 million, and they went out and bought apartments in Houston and Texas, and they bought them at 13 caps, and they were nervous whether they were overpaying. That's not going to happen today, right? The world is not that world. So you don't have to wait for 13 caps to signal an all kind of a buy signal. I think the buy signal is significantly lower yield than that, because also we're living in a low yield world today, generally speaking, even though rates are a little higher. A 4% 10-year is a low yield world still. Doesn't have to be a 1% or 2% 10-year, which we might end up at, but 4 is still a relatively low yield world. So in a 4% 10-year, if you could get a solid cash on cash yield on a very viable piece of real estate in the mid fives, with all the benefits that come with real estate ownership and the growth opportunity from there, to me, that's a pretty compelling investment. And I think that there's plenty of money in the world for that kind of stuff. So that, I think, is going to start to be bought up faster than people imagine. I think that the window for buying that kind of stuff is going to be rather short. I think that, you know, my brother runs an investment business focused on multifamily, and I tell him I think he should be buying now and buying big for the next year and a half, because I don't think the window of opportunity to buy is going to last very long. For the downtown LA, now that's a whole different story, okay? And I think that as you start to move towards that part of the spectrum of risk, I'm not so sure what happens there. I don't have any clear visibility or even a guess that I would put forth as to what happens to unviable real estate. I think.
Can I take a shot at this one?
Sure, I'd love that. It'd be great.
Stuart, our perspective, COVID and then post-Ukrainian war, investment committees were telling their investors they need to stress. And they parked on the sideline. And what drives this activity that you've asked about it is, what will equity do, right? When are they going to come back in and say, go buy, we want to buy? I think that drives it. That's a function of interest rates and then psychology. I think we're starting to see a little sideline fatigue, which we saw at the end of, in 10 and 11, when a few big boys came into the market and bought a bunch, and then everybody followed. So with interest rates having come down a point, that's usually valuable to, particularly in retail. Multi and industrial have a little disadvantage in that they started those cap rates that we turned this cycle from were so low that they have a little catching up to get to positive leverage. But retail is closer to positive leverage than multi and industrial. And retail's become a little bit more in favor for people on a relative basis because of how expensive industrial and multi have been, and forget about office. So you're sitting in a little better spot. But I feel like people always say 9 months. Wherever you are in time, 6 months is too short and a year is too long. So they're always predicting 9 months is when we're going to see a change. And it feels to me that we're probably for end of first quarter, second quarter, to where, let's say, one significant investor turns the green light on for retail and others will follow. So that would be my timing, as long as this rate cooperates. And like it has, Ethan's predicting lower interest rates. Bill Ackman's predicting lower interest rates. I don't know anything about the future of interest rates, so I'll defer to them.
So Simon, now that you gave us the update, can you talk a little bit? You've seen a number of cycles, and before the call started, we were talking about you were comparing it to past cycles. Can you provide some perspective of how this looks to you? How does it feel to you compared to the other ones?
Sure.
And give us your gut instinct of what to expect over the next year.
It's probably a little closer to COVID than 9. 9 was a pure liquidity crisis. There was no money. Our volume in 9 versus 7 was off 90%. And I think in our industry, we're off, 40 to 50% from last year. And COVID was probably not even as a large of drop. So totally different than 9, even though this is different than COVID and came about for different reasons, interest rates, the war, it's behaving similarly. But the interest rates here are by far the biggest factor, I think, in what's the slowdown, because negative leverage is negative leverage, and you'll have a lot of equity investors. You show them deals, but if you really press them to see if they'll do it, and if they're really in the market, the answer has been no. They don't have enough. 2 things: one, they promise distress, just like during COVID, and 2, they don't have enough data points to go to their investment committees and get comfort in, okay, we're going to do this deal. And then they go to their investment committee, and the investment committee said, like they always do, give me data for our residual cap, give me data for our going in cap, and they have no data. So we should have more data where developers and owners are willing to take no profit, sell, merchant bill, just get out of it, move on to the next one. That'll create some data. and that'll happen in 6 to 9 months. Again, everything is 6 to 9 months. But I do think that actually happens in end of the first quarter and into the second quarter. If rates cooperate a little bit more, we're very close on positive leverage for retail right now. We've got that, the Treasury down 100. We've got credit spreads on the best stuff in the high ones at modest leverage, and then maybe 2 and change at a little higher leverage, and then upper 2s. So the full leverage deals are tricky right now if you're buying at a 5.5 or a 6. If you're buying at a 7.5, then you've got a shot at a thesis.
Simon, you and I have a unique perspective. We see a lot of players very closely, and over our careers, we kind of focus on a few that have been really astute and smart players over the years in terms of taking advantage of opportunities. What are some of the smartest players you've seen? How are they treating this market? Are they looking to jump, or do they feel like they have to wait another year to look for opportunities? Kind of tie into what Ethan was talking about.
I think they've been pretty frozen for the most part now, mainly because rates have been unattractive. But we're mostly in retail. We have a pretty big pipeline. I'd say one of our biggest pipelines. It's almost entirely refinancing. Right now, we did one equity raise on a really nice asset in DC. It was a once in a 10, 20 year opportunity where something like that became available, and we put a family office in for, I want to say, $25 million. And that was a core-ish kind of deal. But other than that, I'm not sure we've taken any retail equity deals to market that we could get comfortable around the pricing, the thesis, the value creation. So it's mostly been debt for the last, I'd say, year.
So I have a question on refi, and I'd love to ask you, Simon, first, and then open it to everyone, including Ethan. If you have loans coming due this coming year, do you go long? Do you go 10-year fixed, or do you do bridge for a couple of years and then, hope to take advantage lower rates, hopefully down the road? What would you do?
This is the first time I've had a tougher time to answer this question in my career. Larry Ackman always taught me, if the deal works, fix it long. Real estate's a long-term asset. Then we had what rates were 6 months ago. Now you're thinking, all right, maybe I do a flexible prepay with a credit union or someone like that so I can get out of it in 2 years, because everybody was predicting lower interest rates. So we did a bunch of credit union deals and bought some flexible prepay. And one other sub part of that, people ask us, should they lock rate now? And they've asked us 3 months ago, 2 months ago, 1 month ago. Imagine the volatility in that period of time. My answer is always, would you feel worse if you didn't rate lock and it went up 30 basis points, or if you did rate lock and it went down 30 basis points? Well, that second scenario doesn't really happen very often, but it just happened. And we have people that just rate locked a month ago and rates are down. So they always say they'd be more upset if they didn't rate lock and it went up 30 basis points. But I can tell you they're pretty pissed off now if they rate locked and they're down 30 basis points. But I'll let the others.
I have a question for maybe Sandy and Stuart. It seems to me every time there's a big market move, and with rates having gone up by such a significant amount from 10-year Treasury 1.5 to 10-year Treasury pushing 5 recently, that creates a big pricing move for all financial assets. In real estate, because there's not a publicly traded element to it to a certain extent, and without the pressure to sell, there's no reason to sell. And so markets get frozen, and as Simon just spoke about, transaction volume basically shrivels up because sellers don't want to, if they don't need to, sell at the newly low prices and take a 30, 40, 50, whatever % hit. And buyers clearly don't want to buy at yesterday's prices. So nothing happens. Sandy and Stuart, you guys own assets. How do you think that gap has narrowed from its high to where it is today? between what a seller, if you have to sell an asset, would accept and what a buyer would pay? Are we getting closer to kind of those two meeting?
Well, look, I'll take that. And Stuart's in a different spot because, again, he's in a publicly traded company, and to some degree his currency, which is his stock, moves. Look, in our case, we're coming off one of our best years of acquisitions ever, but they were all situational. They were all situations where someone looked at the facts that were taking place and said, I may have a year left, but when my year comes up, am I going to have to buy a cap? Am I going to have to put up more equity? Am I going to have the money to replace a major tenant? All these situations that look like in a low interest rate environment, they would just roll over because rolling over had a very small penalty, offset at a much higher penalty. And so yeah, there was some movement. And I wouldn't say it really was in the core area. I would say it was in that area where you're buying, like we bought 2 deals in Illinois. Okay. There's tax risks there. There's fiscal risk there. There were a number of other things, but we know the market better than the sellers, and, they had reasons to sell. So yeah, there was some narrowing. My sense is that people, when you have 100 basis points drop, people are optimists and they just program that out and say, well, maybe I am going to make it to the finish line. So that's my first comment. Second is, I agree with Simon. I almost always, although I think, he said it's getting tougher. For me, I always know the business I'm in. The business I'm in is not predicting interest rates. The business I am is properly assessing the risk and the proper cap rate I should receive from buying an asset. And I did lock rate on a couple deals a couple of months ago, and yeah, I could have gotten them a little cheaper today. But one thing I don't have to worry about is the cash flow is what I predicted it's going to be, and it's going to be that way for a bit. And God forbid I have to pay the fees down the road because it gets so much better. That's what I'll do.
Yeah, I mean, look, I think that the problem that we have had, and you could have this conversation sector to sector, because I think, as Simon touched on, certain sectors have a lot of supply coming into the market, which is having a different type of impact.
The one thing we have in retail, in terms of it kicking up, we had 10 years of this country is over retail. We all lived through that. We didn't have that in industrial. We didn't have it in multi. We had it in retail. So over those 10 years, retail cap rates were gradually moving up. And over those last 5 years, industrial and multi cap rates just continued to get lower and lower and lower. So we had that. Then we had COVID, which was probably and Amazon. So those two things happened around the same time. And the retail that survived those 10 years, 8 years, whatever it was, and that survived COVID and Amazon and online, and they're surviving right now, are in a much better position as assets than maybe other assets in other industries. And the second thing is, because you've had that, and their cap rates are higher in retail than multi and industrial. Multi-industrial has some issues when these construction loans come due. I'm talking to a lot of people. There may not be a recap. They may have to sell those assets or stay in for a tiny piece. But build for 100 and it's worth 125, and now it's only worth 100. What do you do? Or it might be worth 95, or it might be worth 102. You have a lot of that in multi and industrial that you don't have in retail. So I do think retail comes back a little quicker because it's the fastest asset, maybe hospitality too, to positive leverage. And positive leverage is a driver for some investors. So I'm trying to give you some upbeat.
Simon, to your point, for years, practically most of my career, I had to always apologize almost for being in retail. A lot of my friends, especially from SC, we did our MBA together. They were like making fun of me being in retail. But with, like you said, with Amazon and the scare of Amazon, with all the things that happened, I think there was a lot of money stayed away from retail. And we have a number of institutional clients that had a directive to get rid of all their retail but before the pandemic started. That same group now wants to add to retail once this redemption period is over. So I think, I think when you take the interest rates out as a variable, the cap rates for retail relative to other asset classes, the spread is going to come down, and retail cap rates are going to go lower relative to the other assets. We're already seeing it more. Apartment trade they're selling apartments because of worry about regulations, and they're moving into retail buildings. So that's a trend we're seeing too.
Yeah. Well,
yeah, look, guys, let's not forget that there are other fundamentals and other issues moving around that we didn't have in retail. We've got shrink, which has become a very big issue. We've got the internet out there that's continuing to gain some ground in terms of our business. And then you've got private equity out there who invested in retail in a pretty big way as we went through COVID and coming out of COVID. That, in my view, is running into a bit of a brick wall right now as it relates to a number of, retailers that they acquired because their cost of capital has gone way up. And if fundamentals, again, begin to slow down, that has a very big impact across the board, a lot more than a lot of us understand, because there's a lot of concepts out there that grew during COVID because private equity was there that today are moving in another direction, and those can unfold very quickly in the retail world. So I'm not trying to be negative per se, because tenant demand is still so strong. But all I can tell you, looking at and the retailers I speak to every day and what I see on the ground, is certainly things are beginning to slow down. There's no question about that. And it depends on the segment, of course, that you're looking at.
And I'll say two things. One is because I'm always pigeonholed as the data guy, because of all of our because of the technology we use. The good news, bad news on retail is it throws off more data than any of the other product types. Okay. And the good news and bad news about retail is, unlike an office building, an apartment, industrial building, the success of the tenant in your space directly relates to how likely they are to pay your rent and how much rent they can pay. And I think what we're seeing is, and certainly depends on the tenant, we're seeing some softening in consumer demand to spend money, because in some markets the disposable income has been pinched by rent, inflation, other factors that are real to them, right? Gas, all these things are taxes on them. I think the good news is, from a buyer perspective, good operators are going to be able to do much better with retail than bad operators. You cannot trade out of an apartment and manage a retail center just like you manage an apartment building. You got to fight for the customer. And so I think the good news from a buyer perspective is the qualified buyers are going to beat out the guys who just decided to trade out of something to buy it, or the private equity that just treated it as a financial instrument. And I think that's what we're seeing. And for me, you can still get, and Simon, to your point, every deal we bought so far this year, except for one, because it is value add, are all positive leverage. And they're going to generate cash flow. And so values change a little bit over the time. I don't care, because I'm getting my cash flow, and I'm willing to fight for my customer and make my center the number one center in the trade area. And I think over the long run, that's going to continue to be a benefit for those of us on this call that take retail as an operations sort of business, as well as a transactional business.
Sandy, you said, this has been one of the most active years for you in acquisition, so you're not waiting, right? So can you talk a little bit about your experience being in the market, buying, as you deal with sellers, and you're looking at the market and buying and selling, as far as also dealing with the lenders in your acquisitions?
Yeah, I mean, all of our deals except for one were products of deals we've been working on for over a year. So when you looked at like what got us here, it was a product of a long time until a seller came along, and we always we hung around the hoop, and we were ready to close, but we were ready to close at a number. And like we said earlier, the market's been somewhat frozen. So if you have cash and you're willing to transact, that was a good thing. The majority of our money comes from life insurance and life insurance lenders, we're prepared to come in with a decent amount of cash. We were able to get those closed. We had a couple debt fund deals. Those are a lot tougher to get done, much more expensive, right? the deal has to be worth the squeeze, right? To put up with all that stuff. And so I think that's been our experience. But again, we're buying things we're going to be glad to own for the next 5 or 10 years. We're not, we can't time, in our view, we can't time the market. And the capital that came into those, besides our own, was capital that said, you know what, if I'm getting 4% even in the bank and I can get 8% current, and I get upside and I get some tax side of that, that's a good deal. And I'm not getting that apartment, so I'm not getting industrial. And where else am I going to go besides that?
So talk about that private capital, Sandy. Are you seeing more of it or less, or are they hesitant, or are they pretty eager to place money?
Yeah, I think our capital's been. There's got to be a reason, right? Okay, so no one's coming in and saying, "Hey, I'll just buy at market just to get a kind of a flat deal," because these markets are too just unpredictable. And the stock market's been good, right? So you look at that and say, "Should I pull money out of stuff?" But again, the deals we did well below replacement cost, with good sales. Again, for us, key was good sales, good traffic, number one in the trade area. Yeah, I mean, and you're seeing this, Reza. There weren't 5 bidders. There were 1 or 2, and they've probably been to the market 2 or 3 times. They've had failed execution on sales, and finally it was like, hey, here, if this is your price, can you get it closed, and when can you close it? And I think our equity's been good there, and but there has to be a reason. It can't be Joe average deal.
Everyone's talking about changes in the world. AI is the big thing everyone's talking about. Love to get everyone's feedback on how you're looking at AI. How do you see it impacting real estate? Ethan, maybe we start with you. Any thoughts there, and how you're leveraging it?
Well, I mean, I'm not leveraging it at all personally right now. I think it's just a little early. I think it's going to be very hard to, forecast that. My guess is it's a negative impact. I mean, when you talk about the impact of AI on real estate.
Yes. Yeah.
I mean,
Yeah,
I
I
think,
mean, look, as AI it's here to stay. It is going to have an impact. It's in the early stages. I have been very on AI as it relates to our business model. Where AI has begun to make some progress in the real estate world is in my view, is on the investment side. That's where things have progressed a bit quicker. And on the data side, it's progressed actually pretty well as in certain platforms, and that's really relative to information at your fingertips a lot quicker than what we currently have today. But we are still in the early stages, and it is going to accelerate quite quickly. I've looked at a lot of platforms over the last 6 months. I'm interested, in making an investment into the AI platform for our business. Sandy and I touched on it. I think last time we saw each other, we spent a bit of time on this. But certainly, over the next 6 months to a year, it is going to begin to change our models. And it will start on the investment side in terms of really data related, but then it's going to move out into the world of finance, the world of operations, and other areas that our business consists of. And when it gets there, it is going to have some impact. There's no question about that. At all levels of our business model. It's just a bit too early right now, but it's coming. It's coming very quickly.
I mean, I guess it's going to be, right, Stuart, it has to be negative. It can't be positive.
It's going to make decision making a lot quicker in terms of what we do. We'll be able to get data across our real estate and our tenant base a lot quicker. And it will have an impact in terms of overhead. You're going to be able to.
Well, just simply put, if it creates instability to the employment base,
right?
Doesn't that have a fundamental negative impact on pretty much all real estate?
It's for the positive, though, at the end of the day, because if your cost of operating are going to drop, and your efficiency factor is going to pick up, and which is going to really have an impact at the margin in terms of operating. That will help. There's no question about it. But there'll be a bit of pain along the way. There's no question about that.
Ethan, what I would say to that was, I mean, I think the spreadsheet put some people out of business and put some people into business, right? And I think that, technology has always been a disruptor. And, I think a lot of our, productivity gains over, the 80s and 90s were driven by, productivity gains. I think AI is a double-edged sword. There's a great book. If you haven't read it, you should read it. It's called Scary Smart. Scary Smart is about AI, and it talks about, good parent, good outcome, bad parent, bad outcome, and how that impacts AI. But I agree with Stuart. I think there are going to be, look, the bane of my existence, Camrex, okay? The bane of my existence, proper accounting and abstracting leases, all these things, and proper billing and matching up bills, all can be an AI function. And look, some of that today is outsourced to India, right? So, I mean, I don't know which jobs are impacting, but also there's going to be an industry around supporting and feeding AI. But yeah, it's dangerous. The good news for us in retail is, like I said before, nothing generates more data than a retail, and that data is now up in front of us, and AI will provide a filter that will eventually be table stakes for all of us. But the first movers are going to be the ones that will really benefit from it. I mean, my favorite example, one, because I'm an investor, but two, because I think we all use it, is Placer. Placer went from being a verb to a noun. I mean, now you placer something because you want to say, how does your center rank by traffic, and to compare to other things? And, that's a huge insight we didn't have 4 or 5 years ago. So I'm a fan of it. I actually think it will be one of the biggest accelerants for our business. But there's definitely societal downside. I'll say that for sure.
How about you, Simon?
Every technology that's ever approached our business, we've been all over to see what the impact could be. I think Placer is a good example. Sandy, we use it. Our guys use it for every retail financing as support. But no, there's nothing in the placement side yet, other than our ethos is find money, find money, find money, find new money, find new money. So we haven't really been using AI to do that, but we use other sources, and including getting out there every day and every night trying to meet with people. But it hasn't been an AI impacted our execution yet.
So I was reading Ethan's book, and there was two areas that I really liked. He talked about the idea of canary in the coal mine, and also the contrarian. And maybe I'll start with you, Ethan. Can you talk a little bit about these two concepts, and what are you looking for as certain signs to watch next year, and any contrarian plays that you're looking at? I'd love to then move to everyone else.
Where I think there might be a contrarian play setting up for next year.
Yeah.
You know what, Reza? I think that there's a lot of capital on the sidelines, right? And maybe, that's an interesting story, the unprecedented amount of capital that's on the sidelines. I think that if the risk-free rate continues to trend lower, then that money has to express itself into risk assets, including real estate assets. So I think that a possible surprise could be a lot more robustness, resiliency, and vibrancy than I think everyone on this panel is feeling today. Just kind of comes to us, and that could be a big kind of surprise. That next year is the beginning of a 2 or 3 year run that feels like a historical a bull run, where money is trying to get yield and there's not a lot, and it's competing in a world where there's not a lot of yield. I think that that's not implausible, and it would be, based on the energy level of everyone on this call, and I think everyone in the industry, that would kind of catch people by surprise.
And even I tend to, no one knows for certain, but just being in YPO and talking to a lot of international investors, I get the sense really this US is the place to be right now. And a lot of money is now focused, even more to come here. So that could be a contrarian play.
Yeah, I think a surprise on the upside is what I would say would be the surprise that I would say is possible, and not counted upon by many today.
Great. How about you, Stuart? Any thoughts on that?
Well, look, I mean, it's no secret that capital today, the contrarian plays are the sectors that have been out of favor. Office is probably one of the biggest ones out there, because I know a lot of people who have capital and have begun to play in that sector very recently on the basis that work from home will continue, but in a different environment, as you might call it. So to me, where I'm seeing capital go right now is into places like, we'll call it, and Ethan touched on this early on in his comments, but in areas that no one wants to touch. That's where I think capital is beginning to play right now. And that's a 2-3 year, maybe 4-year horizon, but the returns are enormous if it's the right call, as we might say. The other place where capital has been moving to quite aggressively is on the fact that a lot of owners out there, and I think Sandy touched on this in terms of opportunity, is the fact that balance sheets have to be recapitalized. And as you look into 24 and 25 and look at how much debt is expiring in those 2 years across all sectors, the play right now is to, look at recapitalizing some of these great assets out there in all markets, and potentially use that capital in different stacks, as you might call it, of whatever capital stacks exist on these properties, because I believe that's potentially going to be a great place to be 2 years from now in terms of either direct ownership or in terms of getting yields, both unlevered and levered, that are much better than what you're getting today in the marketplace.
Thanks, Stuart. How about you, Simon?
I've never been one to make many predictions about what's happening with rates or the future, and I probably shouldn't start today. When I think about
we're not asking for predictions. I love Warren Buffett's quote that says, I learn more about the personality of predictor rather than the predictions they make. I think it's more about if you had a hunch, or like if you were to say what could be a contrarian play, what would it be? And
again, that you're probably asking the wrong person. That I think that the more entrepreneurs, I just think of our blocking and tackling, and we got to block and tackle, and I need the best players on the field. So it's I don't have a view of what a good contrarian play would be, other than everyone's talking about office being a good contrarian play, but I don't even know that I have conviction around that right now.
Thanks, Simon. How about you, Sandy?
I'm so boring. I don't know that I have a contrarian play. I think I have one piece of wishful thinking that I think could be meaningful, but I can't. And I believe it will occur. I believe we're going to find a way to construct things more efficiently and cheaper. And I do think that will provide a real change in dynamics as far as how properties are priced and the efficiencies of leasing space. And I think that's probably a 3-5 year horizon, all part of this AI theme. And I think that's long overdue. Construction hasn't changed in 100 years, probably longer. And we're keeping our eye on that. That will change the housing side of the equation. Well, I think number one.
So we're reaching towards the end of this call. I'd love to leave about a few minutes for Ethan to give us a final thoughts and his thoughts for us. Ethan, you've heard a lot about the discussion. I really appreciate your participation as well as everyone else on this panel. Before I move to that segment, any burning question you guys have for each other? Any?
Yeah, I
No?
have.
Go ahead, Stu.
And that is, when is he going to bring back the Newmark, parties that we all had? I mean, those good times or bad times. That's what made my year was the Nomura parties that Ethan threw. And that's my question for Ethan is, when are we going to be able to celebrate like we did back then?
Well, I mean, I think that's a very good question, Stuart. Meaning, I think that it's, I wrote a book, as I said, on philosophy, and finding a way to have joy in the day is both a wonderful life strategy as well as a wonderful business strategy. I think everyone on this call is pretty good at, some better than others, of really embracing joy. And I have a chapter in my book called The Bubble of Joy. And I think that creating a bubble of joy around oneself is both enjoyable for the person, who creates it, because they're living inside of that bubble. But I think it's a wonderful business strategy, and it becomes a very attractive magnet for everything from capital to opportunities to, high quality employees. So I think that, I'm glad you mentioned that, Stuart. It was a great strategy to create at Nomura this kind of shared joy that I really feel we nailed uniquely well at that time. I think the use of music in intimate settings was really a great marketing tool. But I don't know. I think that it's fun to be creative. It's fun to think about how to approach life differently than everybody else. And there are times that that's not appropriate, which is why in my career I've taken off blocks of time, because it's no fun for me to be in the game when that's not the right time. I think that, again, periods of dislocation are invitations for creativity. They're invitations for differentiation. And Reza, you asked me to kind of give you some closing commentary. I think it would be, this is definitely a time, and I don't see it ending soon, where in our business, there is a huge opportunity for differentiation, for how to conduct oneself, how to create differentiated attraction to you and your business from all the constituents required to be successful, to have a differentiated vision and to pursue it with courage. I think those are the kinds of things that dislocations scream out for and reward. I think that sitting on one's hands and trying to kind of navigate the status quo is actually a very rewarding strategy at times, but I don't think that's our time today. Like, I don't think that's what we're in today, and I don't think it's what we're going to be in for the foreseeable future. So that's, to me, understanding, I don't know, Simon might have said it, that I start with 10, 30, 50,000 feet above the sky when I think about things. Because if you don't get that right, then everything you do on the ground can be wrong, undermined. And all of your great investments of energy, if you don't get the big thesis right, you're swimming against the current. And salmon are a good example of how that doesn't look too good after a while. You get beaten pretty badly. So I think that there's a lot of opportunity because of dislocation, but I think there's going to be a lot of destruction because of dislocation, and that's what dislocation does. I think there'll be winners and losers. Not everyone's going to win. That's going to be good for the winners in every way. Capital will be kind of finding them, will be attracted to them. But at the outset, I think that's very hard, right? I think that when you are talking differentiated story, capital's scared because capital doesn't get paid to take risks of loss. And when you're talking about new ideas and differentiated stories, I think that's the challenge. So again, I go back to my Nomura experience. The miracle of my success was having Nomura. If I didn't find Nomura, my success would have been quite a bit smaller. So, those who can tell a compelling story for some sort of a differentiated game plan can really emerge in periods like this in every business with a monster success. And I'm excited to see how that plays out.
Can I take two lessons from Ethan and share them? He talks about Nomura, which is the capital, and the capital drives us. It drives all of principles in the business. It drives the business. If you are going into an acquisitions role and your capital isn't attractive, then you have no money. It doesn't. You have to have a capital, and it has to be attractive money. And Ethan had attractive. He had money, and he had attractive money. Two important points to having money: it has to be attractive money, or you don't win. And the second thing Ethan did, though, he didn't take enough credit for it. And the biggest lesson I learned from spending a lot of time with Ethan in 91 and 92 and 93 is the importance of his success and his company's success that was created out of the team, and the team being happy and the team enjoying their work experience. There was such great energy in their office. It was different. And I think that that's so important for all of us, to everybody on this Zoom and everybody in business, to make sure that you have the right team in place, because he had a lot of pieces. That puzzle had a lot of players, a lot of people who are pretty well known today in the industry and have gone on to great success. But he had them all together, and it's not easy to have all those people under one roof. But he did it and created a great environment. So you can smile wider, Ethan. That was.
I definitely think, and that's why I wrote a book that seems like a philosophy book, because I do think that getting the philosophy right is the foundation for enjoying success in every facet of your life, and business especially, certainly included, if not especially. And I think, Simon's right, is that I have a chapter in my book called Bubble of Joy. And I think that anyone who touched my business at Nomura felt that they were touching or living within a bubble of joy. And I think that magic attracts everything good, right? Attracts top talent who feel their life's enjoyable being part of something that's joyful. I think it attracts counterparties on transactions who want to be part of that and who also feel like they're going to be treated well, right? And they were. I think it attracts vendors, it attracts deal flow, attracts capital, attracts everything. And so we underestimate these kind of soft things when we think about building a business. But joy and a bubble of joy is, I think, is as key to every success I've ever been a part of as any other thing. Getting the macro right is another one. But joy is something that goes underappreciated. And I'm glad Simon mentioned it.
So Ethan, I want to thank you, because my family thinks I'm a little cooler than before. In my home gym, I started playing U2. In his book, Ethan talks about some of his favorite songs, the U2 songs. You reminded me to go back to the U2 songs. That was a lot of fun.
Yeah, well, that was another topic in the book, music, and I use music very, very importantly in building my business and creating that bubble of joy. And music's been an important part of my life ever since. In fact, I've been on a lot of podcasts since the book's been published about 6 or so weeks ago. A lot, maybe 13 or 14 podcasts. And a lot of them are industry related, finance or real estate. But I was a guest on the podcast of JJ French, who is the founder and lead guitarist for Twisted Sister. So that was a fun experience too.
Everyone should hear Huberman's podcast on music. It should be a higher up chapter in all these longevity authors' books, but it's high up on his.
Yeah, it's very important music.
Well, we're almost at the hour. Any parting thoughts, Sandy, Simon, Stuart?
Oh, although I think you hit on something very big. The most important thing everyone should take away, and the holiday season is a good time to do it, is you should have joy in your business. The best thing I did all year, because I always think back, the best thing, I was Santa Claus for 300 kids in the Inglewood School District. You see life through Santa Claus's eyes, you're going to feel pretty good about the world. So I'm 100% aligned with the searching for joy in what you do.
How about you, Simon? Any parting thoughts?
Grateful to be here. Reza, thanks for including me with this esteemed group, and I look forward to doing it again with you.
Thank you, Simon. How about you, Stuart?
No, just obviously, happy holidays and happy and healthy New Year to everyone. And, certainly moving out of 23 and into 24, I think 24 hopefully will be a more active and exciting year.
Ethan, top of his book, there's a big recommendation for his book by Tony Robbins. And, I did early in my career, I used to do a lot of Tony Robbins seminars and walked on burning coal. One of the things he always said is that the bigger the uncertainty you're willing to put up with, the bigger your life. And I think we're in a world of a lot of uncertainty. And I love the quote from Ethan's book that said, accepting and embracing insecurity is the key to leading an enjoyable life. So thank you, Ethan, for being part of this panel for us and inspiring us. Thank you, Stuart, Simon, Sandy, for your participation. Really appreciate everyone on this call and wishing everyone a great holiday and a great new year. Thank you, guys.
Thank you.
And each of you. Have a great holiday.
I always like to see who stays on till the end.
Hey, well, since you're here, I'm here.